And the Bitcoin price, while it broke through 100 to, I think we got to 108,000, it's come in a bit, and makes sense that it'll be testing a breakout. As you know, we believe that the Bitcoin price has miles to go for all kinds of reasons that we will delineate in our Big Ideas report. Our Big Ideas report will be out in a few weeks. And in that report, you'll see how we get to our Bitcoin price forecast. We are in print, the bull case being 1.5 million. And while we have changed the way in which we get there, we do believe we're going to get there, especially given this administration's sponsorship of Bitcoin. It may even end up as part of Treasury's reserves. So
Cathie Wood is still upbeat about the future of cryptocurrencies, especially Bitcoin, which she thinks will become more and more significant in the world's financial markets. As an indication of even greater possible growth in the future, she cites Bitcoin's recent breakout against gold, which broke important resistance levels. According to her team's audacious predictions, the price of Bitcoin may rise to $1.5 million. Although this number may appear high, Cathie attributes it to Bitcoin's increasing worth as a class of technology assets, which goes beyond its use as a simple gold storage. In the future, she even sees Bitcoin perhaps being added to the U.S. Treasury reserves, which would strengthen its place in the larger financial system. In order to ensure that you never miss a new video, please take a moment to like this video, subscribe to the channel, and enable post notifications before we begin this intriguing conversation. Thank you for watching and enjoy the video.
One of the uses of productivity, a company can turn around and cut prices. One of the other anti-inflationary forces out there is the dollar. Now, if you take out what happened in the early 80s, which was actually a very deflationary period, especially for emerging markets, you can see that we're heading up towards the high end of where the dollar has been over the last 40 to 50 years. So this is a powerful anti-inflationary force, and it is another reason that we expect inflation to continue to unwind during the next year to 2 years. Now, on this next chart, you can see money growth in the purple was negative for quite a long period of time. It moved into positive territory last year. We're still at a very low level by historical standards, roughly 3.5%. You can see inflation in the green line. It broadly, there is a correlation with money growth. Now, the big controversy right now is, are we stuck at this 2.5–3% range? We do not believe that we are stuck there, and that the big surprise will be much lower than expected inflation, thanks to productivity gains, thanks to the dollar going up, and thanks to monetary policy that has been quite restrictive. And I think Chairman Powell still describes monetary policy as restrictive. So inflation typically follows money with a lag. And we do think that we will see more gains against inflation. And we're still saying we would not be surprised to see some negative numbers out there. How could we get those if money growth is turning around like this? Well, we would get that if the velocity of money slows down. And it has been slowing down. And I think the uncertainty associated with the transition to a new administration could be one reason for velocity to slow down, taking any expansionary power away from this money supply growth. Bitcoin, the Bitcoin price relative to gold, the gold price, you can see it broke out at the end of last year. It's testing now. We have seen the gold price go up recently, and the Bitcoin price, while it broke through 100 to, I think we got to 108,000, it's come in a bit, and makes sense that it'll be testing a breakout. As you know, we believe that the Bitcoin price has miles to go for all kinds of reasons that we will delineate in our Big Ideas report. Our Big Ideas report will be out in a few weeks. And in that report, you'll see how we get to our Bitcoin price forecast. We are in print, the bull case being 1.5 million. And while we have changed the way in which we get there, we do believe we're going to get there, especially given this administration's sponsorship of Bitcoin. It may even end up as part of Treasury's reserves. So if we're right also that the gold price is unlikely to move out of control in the inflationary environment, meaning disinflationary environment that we see, then Bitcoin will be responding more to its role as a technology and a new asset class than to its role, like gold, as a store of value. And it should continue to pull away from gold in the years ahead.
Cathie Wood addresses the current inflation and market valuation controversy by drawing a comparison between the S&P 500 and gold. Cathie disagrees with the naysayers who think that inflation and rising interest rates could depress stock values, as they did in the 1970s. She contends that economic trends and policies are actually causing a shift toward disinflation. She also examines the relationship between oil prices and the S&P 500. Even though geopolitical issues are still present, oil prices aren't increasing as sharply as they once did. In actuality, rising U.S. oil production may drive oil prices lower, which would be good for stock markets. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
The yield curve has been very interesting. We've featured it ever since we started these in the know videos, because it went negative and stayed negative for a very long time. You can see here in this chart well, first let me explain what the yield curve is for those who don't know, who haven't been tuning in. It's the difference between the 10-year Treasury yield and the 2-year Treasury yield. And typically, longer-term interest rates are higher than short-term interest rates. And when they are not, when the yield curve inverts, it's usually a period of very tight monetary policy that leads to a recession. So if you look at the shaded areas on this chart, these are the recessions, and you can see that they are associated with inverted yield curves. The yield curve inverts, and then we go into a recession. And it's happened pretty much every time, even pre-2020. I remember in 2019, it's hard to see here, but it did invert for a time. And we thought it was inverting because inflation was so low, and long rates were more focused on inflation and responding to that, whereas short rates were responding to economic activity. Well, we had COVID, and so we'll never know the answer to that if we would have avoided that recession. It looks like technically we have avoided a recession. Now, the closest we've come to this is in 1989. Now, we did end up in a recession then of the S&P 500 versus the S&P 600. 600 is, or that group, it is the small and mid-cap group. And you can see since really the peak in 21, the S&P 500's EPS are up 10%, but versus the peak for the S&P 600, earnings are down 50%. And of course, this is the reason that the market has concentrated so incredibly towards just a few, a group of stocks, the Mag 6, the Mag 7, whatever you want to call them. And we do know that the rubber band is stretching for these smaller companies if they get any relief from whatever measure. And I think deregulation could be the surprise here. Regulation tends to protect larger companies. They're pretty entrenched and they have great lobbying groups. Smaller companies don't. So I think that deregulation is going to unleash more animal spirits, and we'll probably see the earnings of smaller companies start rising relative to larger companies in the years ahead, especially if, again, this administration does help engineer lower inflation and interest rates.
Cathie Wood talks about the yield curve's intriguing dynamics, which she has been interested in for a while. The yield curve, she explains, is the difference between the yields on the 10-year and 2-year Treasury securities. Interest rates for longer periods are often greater than those for shorter periods. However, a time of tight monetary policy, which has traditionally resulted in recessions, is frequently indicated when the yield curve inverts, meaning that short-term rates are higher than long-term rates. The colored portions of a graphic she cites demonstrate how this inversion has preceded previous recessions. Cathie points out that low inflation and the different responses of long-term and short-term rates to economic activity were the main causes of the yield curve's inversion in 2019. Economic trends were upset by the COVID-19 epidemic, making it impossible to say for sure if a recession would have happened otherwise. Cathie now thinks that the risk of a recession has been avoided, in spite of some concerns. She also discusses the different performance of the S&P 500 and S&P 600, which stand for small and mid-cap firms, demonstrating that whereas the earnings of large-cap equities have increased by 10% since 2021, those of smaller companies have decreased by 50%. Because of this discrepancy, the market is now highly concentrated on a select few stocks known as the Magnificent 6 Inches or Magnificent 7. Smaller businesses, which frequently lack the political clout that larger, more established enterprises have, stand to gain from deregulation. According to Cathie, deregulation may result in smaller businesses making more money than larger ones in the years to come, especially if inflation and interest rates continue to drop under the current administration. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.